Hi, this is Professor Shepard, and I wanted to walk through this problem that you'll be having towards the end of the semester. What you're going to be doing is looking at a company that you're going to be buying in another country. So you're a multinational corporation, and you're buying a company in the country of your choice. You've determined that it has free cash flow of $150 million and it grows at 9% a year. So if I grab my calculator, 150, turn it on, 150, 9%. For the first year, you'd have 150. For the second year, you'd have 163.5. For the third year, you'd have 163.5 times 9%, and so on. That's how you would grow your company. To find your free cash flows. We're going to go out 5 years. Okay. This slide just gives you background information. That's all it is. None of it goes into your calculations except for the perpetual growth rate of 2.5%. But this is your company. Now remember, and the tax rate really should be 21% because the tax rate's been reduced. I'll have to adjust that. But this does not go into your calculations. The only thing important for your calculations is the perpetual growth rate. And that's something you'll be focusing on later. The debt to equity for your company is 50-50, but that's not important. What's important is the tax rate for the company that you're going to buy. If they're in the UK, you've got to do some research and find out what the corporate tax rate is in the UK. The cost of debt I've given you, so you don't have to go out and calculate that. We are going to use the risk-free rate of the 10-year Treasury for this calculation because it's a longer investment. I know when we use CAPM, sometimes we use the 3-month Treasury, but here we're using the 10-year Treasury. So you're going to have to do research to find out what the 10-year Treasury is, and you're going to have to show me that research, how you found it out, okay? Not just a footnote. Write it and let me know. The market return is also determined by research. In the United States, the market return is between 6 and 8%. That's some people think it's around 6, some people think it's around 8. You can choose whatever you want. And for you, you're going to have to figure that out by looking at an index like the S&P 500 over the last 20 years. I want you to go back over the last 20 years and tell me what the average return is. If it was in the UK, you'd use the FTSE. If it was in Germany, you'd use the DAX. If it was in Tokyo, you'd use the Nikkei. And you'd go back 20 years. I've given you the beta. It's 1.3%, so you don't have to calculate that. The debt to equity ratio I've given you is 50-50, so when you're doing the weighted average cost of capital, you don't have to worry about that. The perpetual growth rate is 2.5. Be sure you don't confuse that with the 9% growth rate. The perpetual growth rate is used to calculate the terminal value, and you'll see that in slide 5. And then to calculate the cost of capital, you know this, risk-free rate, that would be your 10-year Treasury. Beta, that would be 1.3. Market return, whatever you figure out the market return is going to be, minus the risk-free rate, which, as I said, would be the 10-year Treasury in the country of your choice. Okay. This lays out how to calculate the weighted average cost of capital. It's not too intense since you know it's going to be 50-50. You're going to have to figure out the cost of equity by using CAPM. You will be given the cost of debt. I've given you the weights. You don't have to go into the 10K and figure it all out. I said it's going to be 50-50. If you had to go in there, you'd have to get the market return for the debt. You'd have to get the yield to maturity for every bond, and then weight average that to figure out what the cost of debt is. A V would be debt plus equity, and we're saying debt is 50% and equity is 50%. So that's easy. Corporate tax rate, you're going to have to do some work to figure out what that is. Okay. And then the final slide. How do you value your company? Okay, you take a look at your company and you look at its cash flows. Just like some of the problems we looked at when we figure out the present value or the net present value, you would look at the cash flows. Here, free cash flow 1, remember we said that was 150 million. Free cash flow 2, we said was 163.5 million. On and on. Go all the way out, do 5 years. Then you're going to discount it just like you do in a present value calculation. You calculate the future value divided by 1 plus the rate. And here, the rate is the weighted average cost of capital raised to the first power, the second power, the third power, the fourth power, and the fifth power, as you can see here. 1, 2, 3, 4, 5. Okay. Terminal value. This is the big number, and it's usually the largest number. You take the free cash flow of the final forecast year. You multiply it times 1 plus G. And remember what G is. Perpetual growth rate. That's 2.5. And then you divide it by the weighted average cost of capital minus G. You get your terminal value. You add it here, and you discount it by the weighted average cost of capital raised to the fifth power, the same as year 5. This will get you the present value of these cash flows. That doesn't mean that that's what you're going to pay for the company. Maybe you'll decide you'll pay more because you want control and you're excited about it. Maybe you think that this value is too high, so you'll pay less. But that's your decision. All right, so I think this should answer all the questions that we've had on this problem. So I'm going to turn this off.